Hello, Janice here. Hope you're doing great. Now we are going to restart our day 3 regarding financial literacy and what it is. So, welcome to this. Okay, great. So, we are live now. Yep. Yesterday, we understand about very crucial topics, which are okay. Let me show you what topics we understand yesterday. It's about it too, which is liabilities and rent or expenses uh, distinction. And if this equation of balance sheet is right, and what is debit and credit, we haven't get answered of these ones, so we will try to get the answer today. And yeah, about the three statements, which are the three friends as per Anjum Bhai. And here we go. It is income statement. It tells us about the how profitable our venture is, and there come two things, which is income and expenses. And the balance sheet tell us about what we own and what we owe, what we already paid, and what we have to pay. So it comes in asset, liabilities, and equity. This is the very important and interesting concept. And asset and cash flow statement, how money actually moves, all three combined. So yesterday we just mainly understand these ones, and we haven't understood the this part. I don't know when it will come, but when it will come, we will learn together about it. So here it is, more about the accounting stuff, and so here the liability. So we should know that it has to be paid, and expenses and liability are different. It can be like it is bounded by the month or the specific period, but liability just bounded uh, to the period until that the amount is invoiced and it is paid. So as we have the example here, if there is a resale, if there is an employee who work for October for us, so there is a payment going to be charged on the 31st of the October, which comes in the expense of the October, and we are going to pay the salary on 5th of November. So from 31st of October to 5th of November, that salary comes into the liability, and once it get paid, it will be removed from the liability, but it will remain in the expense sheet, uh, because it is the expense occur for the month of October. So that's why we have to know about it. And there is a confusion that liability and expenses like a double entry. So these are not the double entry because they are coming in two different sheets. So yep. uh, okay, so that's what we understood, what asset, liabilities, and equity. So I just understood that asset isn't mean that what the business own. It means that the what is the worth of the business. Okay, and liability, so what is the worth of the business, or what value the business contain. And then we have to know that okay, yeah, but let me know that how much the business owner own from that value, and how much the value they borrowed. So they get the loan, they get the inventory on credit or something like that. So in this, at this point, what going to happen is that uh, and the equation, it is the equation, it just tell us what is the total worth of the business, and this part tell us about who owns how much amount. Okay, so this tell us the owner share in the business, and this tell us the share of others in the business in a simple way. So here's the thing, you have the explanation here about this. And yep, these are the main concept, but we dive into these concepts very detail yesterday, and this is very interesting topic. Interesting. Yep, I really enjoyed it. So let's go and so we have to start from now, from here. But we have one concept which is remaining. This is what is debit and credit, and that's really confusing because the one thing is debit for us is the credit for other. So that when we see two sheets, then it creates confusion. So we have to know there what is debit and credit, and we will get more information about it. So yep, let's see what it is. Hmm. Okay, debit and credit are like grammar. Okay, of money. Mm. And grammar of money. Okay, great. The real meaning, forget what you have been told. Debit and credit doesn't mean good or bad. Yeah, in- increase or decrease, even add or separate. They simply mean two sides of every. Okay, two sides of every transaction. Every time money moves, it has to go from somewhere to somewhere. So there's double entry accounting. One side is debit, the other side is credit. So I have to repeat it. This is not about the good or bad stuff, increase or decrease stuff. It not about the add or subtract. It is like two side of a coin, or two sides of every transaction. So if money go moves, it goes from somewhere to somewhere. So that's double entry accounting. But there's the two angles of seeing the same thing. You can say that, or two sides of every transaction is put here. One side is debit and the other side is credit. So let's explore what it is. The core rule for every transaction: total debits equals to total credits. Okay, so for every transaction, total debits equals to total credits. Always, every rupee, dollar, pound enters and leaves at the same time, keeping the system balanced. Okay, yeah, like someone paid, I pay you $1,000. So there, at my side, there will be an entry of subtraction, and in your account there will be the entry of addition. So that's how it is, I think so. Okay, so think of debit and credit as destinations and sources. You buy a laptop for cash, laptop asset goes up, cash goes down. Yeah, because this reduce my cash. You take a loan from the bank, cash goes up, bank loan liability increased. Yes, you pay rent, rent expense goes up, cash goes down. Yeah, because there is an expense recorded. It's more about the recording of the expense, how it is being recorded or accounted for. So you earn revenue, cash receivable. So cash or receivable increase. Receivable means that we have to get paid for this. And sales revenue, income goes up. You invest your own money into the business. Okay, so you invest um, you invest your own money in the business. Cash of the business goes up, owner's capital equity goes up. So debit show where the money went. Okay, debit shows where the money went. Credit show where it came from. Hmm. Debit shows where the money went. So debit shows where the money went. Credit shows where the money, from where money come from. Debit means the destination. Credit means the starting point. Okay, I think that's the right understanding. Uh-huh. Okay, let me write it here. Let's see what it is. I don't know if I'm doing it right or not, but that's putting my understanding. Uh, okay, let me copy this one and then my understanding. Understanding. So yeah, understanding. So debit means that means tell us no. If I say that means destination, credit means starting point. Might be I am right with this understanding. Okay, so the direction depends on the type of account. Here's the founder cheat chart. Okay, asset and account type increases with asset, debit increases with debit. Okay, decreases with credit. Okay, and appears on balance sheet because this is asset equity and revenue. So where it is appearing, it depends on that account type. Asset increases with debit. Increases with okay, asset increases with debit. Okay, decreases with credit. Okay, it's not making sense right now for me, but let's assume yeah, you're right. Actually, you're right. Okay, liability increases with credit. uh, it means you borrow something. Okay, decreases with debit when you pay it off. I think so, that's it. Balance sheet equity credit increases with credit. Mhm. And decreases with debit. hmm Right now, this is not making sense for me, but yeah, we will see later. And revenue increases with credit, decreases with debit, is become expenses with credit. Oh, okay, so assets and expenses go up with debits, liabilities, equity, income go up with credits. Liabilities, equity, income go up with credits. Assets and expenses go up with debits. Assets and expenses go up with debits. Okay. Liabilities, equity, and income goes up with credit. This rule of every accounting system lives by. That's spinning my mind right now. Let's run through a simple example transaction. You pay office rent 20,000 credit. I don't know why I'm tired today. Okay, you use cash. Okay, you pay. I use the cash. Asset goes down. Credit credit cash. You used cash. Credit cash. You incurred rent expense. Expenses goes up. Debit rent expense. Okay, rent expense debit. Cash credit. Balance no rupee missing. But this concept missing from my mind. So, however, we will move forward and see if it is going to make sense till the end. You receive one like loan from bank, cash increases. Yeah, cash increases. That's understandable. Asset of the business increases. Yes. Yeah. Debit cash. I have to go through what the exact the root meaning of the debit and credit. What is the root meaning of the debit and credit? Uh, might be then I will understand well. Let's go to the root of the not the country but the language and logic behind the words ever get the origin. Yeah, that's the thing. I think I have to understand that. We will know about what these words means. Both words come from Latin. It's the language of the merchants and record keepers of the Renaissance, uh, especially in Venice, where double entry accounting was born in the 1400s. Debit, debri to owe means I take a loan, something like that. What is owed to you, or what you. Gosh, what is owned to you, or what you own, receive. Okay, credit, credri, credri. uh, okay, to interest or to believe. So the trust, I give credit to you, I have trust on you. So what you owe to others, because I entrusted others. Ah, I entrusted others. I give them credit. I give them money because I think they will pay me afterwards. So that's why I I just okay. It means that I give them money. So there's I believe that they will repay me. So what you owe to others, uh, or what is entrusted by what is entrusted by others. Okay, it means that I think so that it is telling us about another person perspective, that what you owe to others. It means that I give money to someone else because I trusted they will repay me. So this is created from my side. Okay, so how I have to put that in my sheet, that I credited that amount, I give that loan to someone else because I entrusted them they will repay me, so it get credited from in my accounting book, but the cash gone. Or what is entrusted by others. So entrusted, let me know more about exactly what this me word mean is. I have some sense, but I have to make sure that I am getting it right. Assign the responsibility for doing something to someone. Put into someone's care or protection. Entrust. Assign. I have been entrusted with the task. Okay, me- it means that uh, they are entrusted that yeah you can do their job. That's why entrusted means I get entrusted, so someone trusted on me that I will do that work for them. So it is more about trust, but who is trusting who? That's making the confusion. So entrusted means what is entrusted by others. Like yeah, like if someone is entrusting entrust interesting on me, it means that they are trusting on me. I I am interested. So that means that someone is have trust on me. That's the thing. However, that second part just confusing. But you own because what is it is what own to you? what own to you or what you. Okay. However, we will explore more about it. So literally, debit, what is due to you, what I have to pay. Uh, mhm. What due to you means that how what is due to you means that what I have to pay because I get a loan, so that is debit. For whom? In my sheet, it is going to be debit, or the person who give me the loan, it is going to be the debit entry in their account. So we have to see that. But what it means is that what is due to you means that what I have to pay for them. So it seems like this debit is the entry. If I get a loan of $1,000, then there will be an entry of $1,000 of a debit in my sheet that I have to pay that loan because it is due on me. Okay, if credit, what you owe to others or what they trust you with. I have not very good English, but what I am understanding is that uh, what you owe to others uh, means if I pay the yeah, if I pay someone $1,000 because I trust them, they will pay me later. So so that credit will be entry in my sheet that I credited this because I trusted someone that they will going to pay me later that amount. So I think so that's the thing. When someone buys goods from you, okay, uh, on credit. So on credit they buy from me. So I gave them the goods, but I haven't get the cash. So I do the credit. I I do the trust on them. So in my accounting sheet, that credit entry will happen. Okay, because I trusted them, they will pay me. So credit means trust. Debit means someone trusted on me. Yeah, credit means trust. Debit means due. Like this one, I think so. There's a better understanding. Okay. Uh, okay. 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 So, if I get this thing, debit means due on you. Credit means you trusted on someone. So I can go in this way, due, like this one. Okay. So, no, not you, man. It is these. It is these. Okay. So that's the thing. Due, debit, trust. Debit means due. What does mean? Due on you. Okay. Trust means you trusted on someone, so you gave them money. So it's like you took a took a loan from bank. that loan amount in your accounting sheet, that loan amount in accounting sheet will have uh, debit entry. Okay, okay. I don't know if I have the right understanding, but that's what I'm understanding. So you give a loan to someone, so you have to just copy and paste that loan amount in your accounting sheet will have credit entry. So there's thing. Ah, okay. Okay. So, uh, think like an old merchant. Imagine you are a Venetian trader in the 40s, 1400s. When someone buys goods from you on credit, you debit them. They owe you. Your asset increases. Okay, you credit your sales. You trust them to pay later. So you debit them. They owe you. Your asset increases. You credit your sales. You trust them to pay later. Debit means value received. Credit means value given. Yeah, there's the philosophy. Value received, value given. Okay, I took the loan. It will be a debit entry in my sheet. I gave the loan, so that value given. So that will be the credit entry in my sheet. Why it's a question more time? Because bank flip the perspective. When you deposit money, your bank account is debited in their books because they owe you money. Okay, because when we deposit the amount, it's like that we are giving the loan to the bank. So your bank account is debited in their books because they owe you. Because it's like bank saying that when you deposit amount in your bank, it means that you are giving us the right to use it, and it's like loan to them. But you see it as a credit in your app because it's your money increasing. But you see it as credit in your app because it's your money increasing. That's why people get mixed. We are looking from opposite sides the same transaction. Deposit the bank account elevated in their books. So credit means I trusted them. Okay, so it become credit. The timeless logic. Someone receives every transaction had two sides. Someone receives debit, owes value. Someone gives credit, trusted to give value. There is no transaction in the universe where only one side exists. Yes, that's right. But there's a confusion. Okay, we will see later. And- Okay, perspective. You, the business, debit salary expense. You receive their service. You owe them. Debit, I owe them because I get that value and I haven't paid them. So it will be like I owe them in my sheet. It will be the it will be in debit uh, because I owe them. That service amount. Employee carrier salary amount. They are interested to receive pay. They are believed. So yep. So debit and credit are just two sets of trust, one owing and one being owed. The deep meaning in business philosophy at root level, debit means responsibility, credit means trust. So yeah, that's good understanding. Money itself is built on the exact duality. That's why every balance sheet is an equation of trust and responsibility. Perfectly equal. Okay, I got it. That understanding, debit means responsibility, career means trust. Okay, so if someone entrusted me, then that thing going to be the debit on my side, and on their side, that value they given me without receiving the value back at that time, then they credit it from in that sheet. There will be the credit on debit. So what he said that uh, it's now making some sense. Founder's perspective, you are receiving value, asset cost, receiving value, the end point destination where the value is coming. So it is going to be debit, I think so. Yeah, when you debit something in your business, it when we are the end point of something, then it will be the debit on our side. It can be the asset, costs, or benefits whatsoever. Because if we take a service from someone and we haven't paid them, then it is debit on us. It is responsibility for us to repay them. So it is debit on our side. And when you created something, you are giving value, obligation, income, or ownership. So it's like obligation. So obligation, income, ownership. So the root idea never changed. I am making some sense right now, which is you are giving value, obligation, income, ownership. So the root idea never changed. It is still the same. In Venetian traders 600 years ago, record what you received, debit, and what you gave, credit. They must always be equal. Okay, because every trust means must be backed by responsibility. Okay, 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 okay. So there is some understanding now. Okay, great. So I think so. I have to come back on it after a break, and then we will explore more. Okay, guys. So I think so. We can move. Okay, so if I conclude this thing, what I understand about debit is that uh, I receive $10,000, then it then this transaction is debit on my accounting sheet. Why? Because because it is due on me to repay them. Okay. um, when I pay $1,000, then this transaction, okay, let me go through the same thing. Okay, when I receive some, the person who paid me that $1,000, then this transaction is is credit is credit on their accounting sheet because it is because they trusted me that I will repay them. That's the other thing, if I'm going to pay them or not, but at least they are trusting me. Thank you for the trust. So that's what it is. I receive $1,000. So then this transaction is debit on my account sheet because it is due on me to repay them. The same transaction will be recorded as credit in another person accounting sheet as credit because it is telling them you trusted Jalis on this $1,000 that he will pay you in future. So that's what it is. So debit saying that Jalis, you have to pay that amount to someone, and credit showing that same transaction in another person sheet is that you trusted Jalis and you give them $1,000. So that's the same transaction recorded on in that's on different sheets and telling us that one person have the responsibility to repay that amount, and the other person who paid that amount saying that I have given this amount to Jalis and I have to get them uh, because I trusted them that they will repay me in future. So that's the main point here. I think so. It is clear now. So that's the same transaction, two sheets, and that's how it is. Okay, let me confirm that. Is it? I think so. My screen not sharing right now. Okay, is it uh, two sheets, two people sheets involved? Is there two sheets involved to represent debit and credit? Let's see that how these are being entered or represented. Okay. Excellent, Jalees. Thank you. That's the question the origin veteran merchant asked when they invented double entry accounting. You have the reason you heard of the system where debit and credit two people's books or two sides of one book. Let's unpack it deeply. Yes, originally two people's perspective were involved back in 1400s when traders kept ledgers by hand. Each transaction involved two parties. One person receives value and another person giving value. So yeah, that's the same thing. If someone is giving me, I'm receiving it, and the person who is giving me is giving me. So that's the thing. Uh, each kept their own record. Each kept their own record. Okay, okay, yeah, 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 yeah. Two persons were involved. Person, buyer, I owe you this much. They received value. Seller, credit, he owes me this much. They gave value. So in essence, one man's debit is another man's credit. That's from where this logic came. One man's debit is another man's credit. Okay, yeah. If I get something from someone, and I haven't paid, then it is debit on me, and who gave me that value, then it is credit on their side. Okay, that's where the system's name double entry comes from. Two entries, there's where the system new entry comes from. Okay, just wait a minute. Okay. That's how it is. Okay, so I got it. Uh, Two entries. That's where the system name double entry comes from, because this the same transaction is being entered in two different books. Two entries for every exchange, one in each person's book, and in two accounts if inside one company. Two accounts if inside one company means that two sheets. There are these are two sheets stuff. How modern accounting unified it. Over time, accounting realized a business itself has both perspective inside it. It both gives receives value every day. So instead two people, the same company keeps both sides in one ledger. You record where where did the value come from? Where did the value come from? Who gave me that value? So it is credit. Where did it get? Where did it go? Debit. Yeah. Destination, starting point. Starting point, who gave that? Who credit? Who give that value? Debit. Who get that value? Okay, I think so. There's another perspective. Debit. Who, I think so. It is right if I write it. Who give that value? Who get that value? So same thing here. So I think so. Yeah, my screen gone. My screen gone again. My screen gone again. So here it is. So you can see now. So credit means who give that value. Debit means who get that value. Okay, so it's like starting point of transaction and point of transaction. So that's the thing. Okay, guys, nice. So yep, we got it. So you buy office and furniture for in Indian currency. Okay, it's good. It's fine. Account debit and credit. Uh, for furniture, you buy office furniture for cash 1,000. So asset furniture debit, because I received that value of furniture. Cash comes in asset and that goes into credit, because that value I entrusted someone for $50,000. Okay, so that's credit, and to whom I I trusted on furniture. So that is furniture is the endpoint of the transaction. It converted into the furniture, and cash is the starting point of the transaction. So it is credit. So from That cash, the starting point, converted into the furniture, and then it is come into the debit column. So cash trusted the furniture is something like that. So that's why cash is in credit and furniture comes in debit. So you, that's the end point of the value. Now the value we have is in furniture form. From furniture's view, you received it debit. From cash use, you gave it you received it because it debit. We received it. You received it because it due or receive. I think so. I have to write it down here when it went to receive. I I can receive, and here it is. Uh, gave gave. So there's the thing. Okay, so here we have this thing. Uh, from furniture's view, both records are inside your own book, and both records are inside your own book. No second person ledger needed anymore. But there are two accounts. One is furniture account. One is cash account. So we entrusted about the cash on someone, so we gave it to someone. So now on this transaction, because cash is going away, then it is going to be credited in that accounting sheet. And where the cash is landing, uh, so then on that point it is going to be debit on that sheet, or on that account type. So in furniture it is going to be debit. So that's the same amount now landed as a furniture, then it's it's get debit in the furniture. Okay, if I'm going to sell that furniture, then what's going to happen, then the furniture, then for example if I sell it for 40,000 now, so then in my furniture account sheet, that 40,000 going to come in credit because the amount, the furniture is going away, that value is going away. And but now the when I sold that furniture, then that 40,000 in my cash accounting book or cash accounting sheet, that 40,000 is entering, or and they have their destination at my uh, cash accounting sheet. So in my cash accounting sheet, that 40,000 going to be credited. So yeah, that's like the starting and ending point of value they are representing. uh, they represent the starting and end and start. Okay, I can say that start and point of value in a transaction. So that's it. Okay, so two people, two accounts. Two people, two accounts. Even within your company, every transaction involves two parties, two accounts. Transaction: you buy from supplier. You buy from supplier. Okay, I buy from supplier. Now I bought it, so it means that the value is landing in my account, and that amount is going to come in the debit column. Purchase expense. For me, okay, you receive cash from customer. Yeah, I get it right now. I think so. I haven't seen this. Now I seen this. So in person two, that the value I buy from supplier, and so in the supplier account book, that amount is going to be credited because the the starting point of the transaction is from supplier. So that's why that that entry of that transaction in supplier book comes in credit. You receive cash from customer. Now I receive cash from customers, so there's cash and it's going to become in debit because it is landing in my account. That my account is the endpoint, and from customer perspective, uh, it is going to be the you receive cash from customer, cash debit, person one, and person two sees revenue. So you pay salary, salary expense come in debit, and person two is cash. Person two is cash. Now here it is making a little sense, but okay, I get the idea. The debit is the end point, credit is the starting point of the transaction. So yes, there are always two entities involved, but they both live inside your accounting system now. That's what the balance sheet. It is balancing. That's why it is called balance sheet. Balance. Think of it like the. I think it's getting too long. I think of it like the conversations in one language. Person A say you owe me $100 or 100 rupees. Credit entry in A's amount because they paid us. Person B says, I owe you $100. Debit entry in B's book. Accounting merges both in one record. Debit one account, debit one account, and credit the other. So that's it. That's why it's called double entry accounting. Not because there are two books, double entry accounting. There's two books. It is called. Okay, double entry accounting. Not because there are two books, but because every story has two sides. One is giving, one is the another is receiving. Double entry accounting is a system where your business talks to itself. Every debit answers, "What did I receive?" or "What increased?" Every credit answers, "Where did it come from?" or "What decreased?" Both must always equal because in reality every value received has a source. Yeah, there's every so every debit answer, what did I receive or what increased at my side, where did it come from or what decreased. Now it's making sense, it's making sense, something like that. It's making sense. Talks to yourself. Okay, now it's making some sense. So now I'm getting some sense about the increase and decrease. If endpoint is me, then that value is increasing at my side. So that's why it is in the endpoint of the transaction. If it's me, then it's come in the debit, and because the value now I own is increasing, so the value overall I own is increasing because of that receiving of that value. Okay, if I am uh, giving that value to someone, then what is happening is that the source of the that value is me. So it, it is going to be in credit because it is coming from me, and that value I'm giving to someone else, then that value amount is getting reduced in my sheets. So that's why there is a decrease word. So yep, it's making sense now. uh, I think so. I have to conclude it here, and then afterwards, after a break, we will continue. Extend inside the double entry accounting crystal clear once for all, because the most and misunderstood ideas in all business finances. Okay, okay, yeah. Just give me a minute. Okay, okay, okay. So now we are here. Uh, okay, double entry accounting simply means every financial transaction has two equal sides, one debit and one credit, recorded in two accounts so that everything stays balanced. Yeah, one debit receiving end, and one uh, and one recorded in two accounts. One debit means receiver and one credit means giver end. So I can also write it as one debit means receiver and credit means giver and okay. So okay, move on. Okay, so that's it. So the recording two accounts that everything stays balanced. It's called double entry not because there are two books or two people, but because there are two entries for every transaction, one for where the money came from, one for where it went. Example, simple but powerful. Let's say you buy a laptop for your business for and keep it in one currency. Keep it in one currency. Don't confuse rupee, Indian rupees, Pakistan rupees, uh, and dollars. Yeah, please keep in one currency. Let's say you buy a laptop for your business for 1 lakh cash, laptop assets. Okay, I buy it. So the uh, at laptop, where is the value? Laptop is the value that comes in the asset. So is it going to be where is that value endpoint going to be told by debit? So now that endpoint of that value of laptop is this one, 1 lakh. So and that cash is gone. So there's the starting point of the transaction of cash. So that's why cash is coming in credit here. So debit laptop value received, cash because credit what is value given, which is cash. We can say that what we received, it is debit. So the value name is laptop. So that is received. So debit increased in the transaction, and the credit what we gave for that value, and that value is cash. So a value given, so that's why it is coming in cash cash in credit column. Both both books. So uh, both sides are equal, books balanced. Both sides are equal, books balanced. This one transaction is a double entry because it touches two accounts. Double entry because it is a double entry, double accounting, you can say, into accounts. Double what I asked, double entry account because that is same amount is being double entered, but in for different form of values. So each value establishing its own set of row, yeah, or sheet. So that's why there is double entry of that, of the same transaction, because that cash is converted into this one, and our company received that value. That's why it is coming in debit. And that cash from our company is gone, so we gave that cash away. So that's why it is coming, it is coming in credit. Okay, so we can say that I have to see that whatever value I am receiving, it is going to come in debit. Whatever value I am giving away, it is coming in credit column. Oh, like this one. Okay, laptop received, cash gave away. With why this exists, before double entry, merchants kept single entry logs like a diary of cash in or out, but that caused chaos. No one could see where money came from. If I have a cash, so got it. So what is happening is that money cause no one knows see where money is came from and why it was spent. Allah. Okay, I say that my cash gone, my cash gone, my cash gone, but where that cash gone, where that value is converted into. So that's why they record same thing in accounting for the company. So when cash is gone, it is going to get into the credit, as you can see here. But the cash is converted into laptop asset. Now it is in received. So that's why it is coming in debit. So we can say that the value being tracked well, because it says that okay, yeah, if our cash gone, then in which value it is being converted, then we have another entry of that converted value. So the 1000 uh, rupees remain in the system. So that's why there is a need of these one, debit and credit. So okay, a four double entry. Merchants kept single entry logs, a diary of cash in or out, but they take because here no one knows where money came from and why it was spent. Double entries of that by showing the cause and effect. That cause cash gone, then the effect where gone, and where it is converted into the laptop. So that's why it came into the debit received stuff. So automatically detecting errors. My cash is gone, 1 lakh rupees, but the worth of laptop we receive only 80,000. Then where is 20,000 gone? So that's where we can detect the errors. So I can ask for the laptop receipt, and if the laptop receipt is only $80,000, 80,000 rupees, then I can ask where is the 20,000, because the receipt of the laptop is saying that it is 80,000 only. So that's how we can detect the errors or the corruption. Okay, so that's the key. Creating the foundation for modern income statement, balance sheet, and cash flow statement. Creating the foundation for modern income statement. Okay, creating the foundation for modern income statement, balance sheet, cash flow. Yeah, creating. Okay, yeah, it's creating the foundation of more for modern income expense income. Here it is, and balance sheet, that asset equation, and cash flow, how the cash is being moved in the business. So that's it. The two entries represent two realities: debit, what your business receives, or what increases in value. What increases in value? What increases in value? What increases in value? Value, the laptop, that machine is the value. So that value is increased. Laptop assets increased in my business, but for that transaction the cash reserves which my business have get decreased. That's why it get credited, because it is the source of that transaction, the starting point of this transaction, and the laptop value is the end point of the transaction. That's why it is coming in debit. Okay. Yep. Debit, where what increase in value, buying furniture asset increase, that furniture asset increase. Debit, what your business gives away or what funded it, what funded it. Yeah, a starting point. Cash or loan decreases, increases. Okay. I got the sense now. I'm not going to confuse myself more. So every debit has an equal credit always. If not, every debit. If not, then there is an error or corruption. Ah, you can see this. I already write it in caps. Okay, you can get the abnormalities from this one. Okay, the balance equation behind it all: assets, liabilities, plus equity. This stays true because every debit credit pair keeps both sides balanced. That's why your P&L, balance sheet, and cash flow are linked. Asset, the balance equation of all assets, yeah, liabilities, equity. This stays true because every debit credit pair keeps both sides equal. Okay, we will go in depth afterwards. Uh, that's why European are all linked together. They are both on the same rule: two equal entries per transaction. A simple entry tells you what happened to my money. Double entry tells you why it happened to and keeps me honest. It's the big reason the investor here can track billion security. The system balances itself mathematically. Double entry, two sides of transaction: debit, what you receive, uh, uh, credit, what you gave. Always equal, always balanced, always traceable. So in short, that one. Okay, and that's the thing I have to understand. Let me get the snapshot of it, and we will not a snapshot. I will just keep it in the question box. Question. So yep, I'm going to collect all of these questions in one side, so I will know that what arises in my mind and what I have what answered. I answered already. Okay. All questions. Okay, so yep. There's the thing. I think so. That's it. But one last thing is remaining here, which is okay, which is yeah. I am getting here confused. I think so. I get the this point done well. Okay, so forget what you have been told. Debit credit don't mean good or bad. Increase two sides of every transaction. Yeah, got it. One every rupee is the boundary the system behind laptop. Now it is making sense. It is really confusing for me. Increases, yeah, there's okay. I'm not going to because it's going to confuse you again. Debit and credit are not action, they are perspective. When you spend something goes up, expense something goes down. Cash, when you earn something goes up, something goes down. The system stays, the system balance. I got the gist of it. Understanding the debit and credit, read the real ledger, spot if your accountant booked something wrong, create your own journals when learning, debug why cash went down but profit went up. Happens all the time. Okay, yeah, there's other concept. So I think so. I have done this one, and there are. I think so. This is the day 2 stuff which I are learning in day 3, and we have to start the day 3 stuff again, but there is something remaining as well in which we have to make that sheet, and we will make it soon as well after a break. And where it is the what it is going to be the third day 3 topics. Okay, the founders met profit growth, vanity metrics, real value, financial habits. We are here are the grocery, mini grocery, okay, mini grocery stuff, mini grocery, really. Sometimes it's spelled like grocery. It's not grocery, it's glossary. Glossary seem like the glowing stuff. Some sometimes I get like it's like makeup stuff. Like glossary. I can't even spell it right. I think so. How we can spell it?
Glossary.
Glossary, glossary. Oh, blossom, gloss. Okay, yeah, that's thing. Gloss, blossom. I think something like that. Yeah, yeah, yeah. There's the shining stuff. Nah, yep. I think so. I'm right in that sense. Okay, it's gloss. It's gloss. I think so. There's a gloss, shine, distract. That's why I'm just confusing this word with shine or the beauty product thing. Is glossary, glossary, tongue twister. So now we have to start this one on the day 3. I think so. Day 3 stuff is going to be start then. Yep. So yeah, after a break we will try to start that one. Oh my gosh, my screen is not showing, man. However, it's fine. So see you then, guys. Okay, bye.